What's up, investors? It's June 19th. I haven't made an episode in quite some time, so I'm bringing an update to the account and see what's going on. I have a very defensive posture happening right now, and I want to talk about that a little bit, and then also what's been going on in the markets and what is the feeling that I'm getting from all of the chat around in the financial world and in the news and media as to what part of the cycle here we are in the market cycle. So first, I'm going to go through the account. I'm going to show you where I'm at. I have the same amount as I had even 2-3 weeks or even a month or two ago because nothing's happened in the account. I'm still sitting in mostly in cash and very, very safe investments in the form of Realty Income and Main Street Capital. So nothing much has changed here in the past month's chart. It looks like this. I have not benefited in the last 3 months. It looks like this. I've not benefited from the rise in the markets at all. Ever since I tried to short Nvidia and got burned over here on May 24th, 25th, I have not really participated in the upside. The appreciation of Realty Income and Main Street Capital are the only things that are keeping me in the game a little bit. This cash over here is earning interest though, currently $94 for the month, and that's probably set to almost double by the end of the month, so that's nice. I recently received some dividends. So if I go here under Realty Income, I'll show you the dividend. It's right here, $157.47, translate into 2.5 shares of Realty Income on the direct reinvestment plan. So 157 here, and Main Street Capital is a bit bigger. My position is bigger. I hold more shares, and total amount of capital invested is higher, translated to $263.52. So it's a healthy dividend plus the interest I'm going to be receiving on the cash that's being rolled over in the money market account. That's going to be about $570, something like that. About 570. So here is the account, the circle graph. I'm looking at brokerage cash of 56,000. So the reason not all of it is being rolled over is because I just recently bought back Robinhood puts. So I sold some hood puts, HOOD, and then I bought them back for a profit of maybe $100-something. I also lost money on buying calls for JD. I thought the Chinese stocks might experience some kind of a boost upwards, but they didn't. So I lost all that money. So it's a few $100s there, plus the bad Nvidia play, which was another, maybe a $6.5 grand or something like that I've lost. So I've made some really poor moves as of late. So I'm kind of sitting in cash to try to figure out and reset. Okay, why am I doing so much experimentation? And I'm trying to reflect on my strategy here moving forward. And I don't want to be too active in the market because not only because I'm getting the direction wrong, I'm not getting a good feel for it, but also because I think the market's kind of elevated for the situation we're at here, especially with these interest rates being the way they are and the macro data that's coming in the way it is. These are my only two positions. They're currently profitable a little bit, and plus all the dividends they've paid out, the total return is actually quite a bit higher than this. So that's fantastic. So 56,000 in cash, about 40% of the account versus 60,000 in stocks and options. That's quite a difference from previous months and years where I've played so aggressively that I had my account leveraged almost 100%, in options and things like that to try to dig myself out of difficult situations and see if I can collect in premium what I've lost in trading ability, basically. Paramount was a big loser for me, and I'm thinking of actually re-entering Paramount now. I did a video on Paramount. If you want to check it out, you can. Look over a little bit of the possible trajectory changing when it comes to their financial situation. which perhaps makes it investable once again. But lost money from that. Smith and Wesson, I lost money from that, even though it's recouped now without me. I had to pull the money out, and now it's gone up. So if I just not touched my account since the beginning of the year, I probably, instead of 140, would have been like a 230 or something like that. So, a lost opportunity hurts just as much as lost money, or maybe not that much, but it's a second order hurt of pain here. However, I have to reassess and try to move forward from here. Now, where are we in the market, right? Well, if you saw my second monitor here, I actually have a chart of Apple. It's a live chart, even though it's June 19th and markets are closed right now. It's a live chart of the price of Apple. The purple line is the VWAP. But it's falling right now in the after hours / overnight trading period. Robinhood introduced 24-hour trading for 5 days of the week. You can see it ticking on right now. So it's actually down 0.6% overnight, anticipating a red Monday. Tuesday, after a very long weekend. What's going to happen to the account if things drop? Perhaps Nvidia is going down as well. Let me see what Nvidia is doing. I had it pulled up. Overnight is dropping 0.74%. So it's also losing a little bit of value. I'm actually going to be benefiting from that because, of course, even though I got burned trying to short Nvidia, I sold 5 credit spreads due until October 20th. So that's when it's going to expire. So I'm betting that the price of Nvidia is going to be under 430 by October 20th. That's the bet. And it's basically an even bet. I've put a cash collateral of $2,500. The payout is about $1,200. So reality, I'm risking about just as much. So it's a $1,200 plus or $1,200 minus by October 20th. It's going to boost my return a little bit, especially if I'm just sitting in cash, realty income, and Main Street Capital. This play will definitely give me a little bit of extra income. However, I'm hoping that I'm able to do more moves by then. However, I think market's a little bit elevated, personally. Please let me know what you think, but I just can't see it. So this is the SPY. It's down 0.26 in the overnight here on the 19th. And I'm just going to pull up some charts here of it. Let me see if you can see that. Yeah. So 1 week chart is plus 1.7%. 1 month chart is plus 6.7. Now, plus 6.7, that's the total return for the S&P 500 on a normal year. That'd be considered average. The market average is like 10-12% or something like that per year, but 6.7 can be considered a pretty good year, and that's what the S&P did in a month. In 3 months, it's done 11.47, so more than an average year in 3 months. And year over year, 20% already, and a lot higher since the beginning of the year. Well, I don't know about a lot higher, actually less higher, maybe. About the same, I'd say. So if you count from December 30th, it was 382 versus 365. Okay, it's a little bit less than 19.92 since the beginning of the year. They used to have a year-to-date chart. I don't see it anymore, but 1 year will suffice. So it's been quite an aggressive rise here. You can see the higher lows and higher highs forming, 3 higher lows and 3 higher highs. And by the time this pattern is established, to me, it seems like it's obvious to all the traders, which means the pattern is probably going to break down. Now, I'm not a technical analyst. I don't do any trades based on technicals, but it does help a little bit to know if we are a little bit overvalued or not. So charts is just one metric. The other one you can do is you can try to look at price to earnings or, other metrics. So for example, the price to earnings for the S&P 500 is 22.46 via SPY, which is basically a mirror of the S&P 500 in a tradable fund, an exchange traded fund. So 22.46 is quite high. I believe the running average somewhere around 15, 16. 22.46. Companies like Apple, who have in the past traded as low as 20 or even 15 price to earnings ratio. Apple now, I don't own any Apple anymore because it's trading at 31.42 price to earnings ratio. Now, PE is not the only thing you want to look at, of course, as an investor when trying to figure out if a company is a buy or not. But that's quite rich. The company in question that we talked about earlier, Nvidia, I'm not buying that. There's going to be so much productivity in the next, 5, 10, 15 years to account for all of this front run increase in valuation. I mean, in the last year, it's going up over 170%. In the last 3 months, it's gone up 63%. In the last month, it's gone up 43%. 43% in the last month. In 1 month. It's now over $1 trillion market cap company. You can't tell me that the newest technologies and productivity increases is going to account for a tripling of the company in a reasonable manner, in a reasonable time period. Nvidia is not a small company anymore. All right? It's not a small company. I know I speak like someone. I've just got burned by Nvidia trying to trade it, trying to time it, which is a mistake, and that's fine, that's fair, and I'll take all the punishment from that. But I don't think that investors are pricing this accurately. No matter how groundbreaking the technology is, it takes a while for it to unfold. Otherwise, we're treating this as something that's greater than the internet. There hasn't been an invention greater than the internet for quite some time. And all these companies in 2000, 1999, 2000, when the stock market was shooting through the roof, they had the internet at their back. And look what happened. Even the greatest company to come out of that period, like Amazon, they still corrected quite a ways down before they were able to recover adequately. Some companies never recovered. Some companies went under. I'm not saying that Nvidia is going to be the same from, the whole AI situation. However, it's going to take a while until the company grows into the boots that investors have given it. Even if it's a certainty that it does, it's still going to take many years. It's not going to be like an overnight thing. And all of that growth is already priced into the stock. So I just think it's a bit silly to be waiting for that long just because you're afraid that Nvidia is going to not drop below 400 and you'll never be able to get back in again. The train is going to leave the station and then you're going to have to pay a price higher than 430 in order to participate in this amazing train. So that's just all I got to say about Nvidia. I just think it's trying to catch it at this level. You better have a really, really long-term horizon, and you better be right that the stock is going to lead into the future like it has in the past. All right, that's all I'm saying. But anyways, I'm super conservative right now, and it's the most conservative I've been with this account ever, sitting on this much cash and just sitting on it. I'm not doing much with it. I've tried some option plays, I did some calendar spreads, but that's about it. So I'm just basically sitting on cash and waiting for the market to come down a little bit. I don't know what that catalyst will be to put the market down. The Federal Reserve recently came out and they held rates where they're at, with the expectation that they're going to raise 2 more times and if inflation stays elevated. But the markets are seriously like that. I don't know what's going to happen next week. It looks like it's pointing down, but we'll see. If I make a solid chunk of my Nvidia credit spread sell then I might close that position for 20, 30, 40% profit. But if it doesn't happen, I'll just let it ride. Maybe even up until October. We'll see. Maybe I'll put some more spreads on if the stock gets more rich, and hopefully I don't get burned for a second or third time by the stock. All right, tell me if I'm wrong. Tell me what you think about the market. That's it. Peace out.